Hi guys, welcome back. Today we will be looking at Alibaba. I'm sure most of you guys are very familiar with this company, but for those who aren't, Alibaba is an e-commerce company, but it was also a holding company for many smaller businesses that it either owns a stake in or completely owns. And these businesses usually follow under the commerce, retail, internet, or technology sectors. It operates in and around in China and some neighboring countries as well. And I believe this stock is at a very interesting time in its last trading session. Over the last few months, since October of last year, the stock is down close to almost 50%. So if you were looking at buying Baba maybe a year or two ago, maybe not a year or two ago, but about a year ago, you're looking at almost a 50% discount now, which in and of itself is a very interesting buying opportunity, especially with the promises of growth that it says that it will achieve in the future. I believe right now is a very good time to enter the market. Another reason I believe it's a very good time to enter the market is it's trading at a PE ratio of close to 20, which basically means that the stock is 20 times its current earnings per share. And if you compare that to tech stocks in the United States, compare it to tech stocks in Europe, in India, in China, in Brazil, you're looking at very, very cheap prices, especially for the growth that it promises. We'll be looking at the growth later on, but I believe the stock is trading at a very cheap price as of right now. Look, if you look at October 23rd, October in 2020, the stock was trading at $310 per share. Currently, it's trading at just around $167 per share, and at a company that has a market cap of $455 billion and has a revenue of close to $110 billion a year. I believe this stock is trading at a very, very, very good time. And I believe it's a good time to invest. We'll be looking at a holistic view of this company. We'll be doing a stock analysis of this. So if you do enjoy, consider subscribing. It is free and it does help me out a ton. If not, thanks for watching anyway. On to the video. So the first thing we'll be looking at is their June quarter highlights. As of June 2021, Alibaba had 1.18 billion global annual active customers, which is mind-boggling. That's close to 1/7 of the world's population, if not more than 1/7 of the world's population shops Alibaba online. So that's quite a large company if you look at the world. And out of it, 992 million are from China and 265 million are from the international community. If you look at their June quarter highlights, two things I want to note is that their revenue had a year-over-year increase of 34%, which is a massive growth, especially since the stock is down 50% since last year. So looking at this, I believe you can see how off-put the market is with this regulatory concern that Alibaba has been under. Their revenue grew more than 34%, but their stock price was down 50%. So that should just be one of the points to see why it's such a good time to buy this stock and why it's such a good time to invest in this company. So if we look at the revenue breakdown, the total revenue was up 34%, but their commerce retail was up 34%, their customer management was up 14%, the other part of their commerce retail was up 32%, their wholesale was up 13%, their commerce retail internationally was up 54%, and internationally is where you're going to see Alibaba grow the most. China has a population of close to 1.3, 1.4, 1.5 billion, and out of that, they already have 900 million customers. So they've basically got a monopoly over China as of right now, and I don't believe that Chinese Communist Party would let them grow any further because they are very wary of monopolies. So I don't see it growing much in China, but their international is where they're gonna grow the most as being a competitor to Amazon. And especially since it's going to be importing goods out of China, it can potentially be giving goods at a much cheaper cost, which would bring in customers. If, let's say, you're living in the United States and you're getting something from Amazon for $10 and you're getting something from Alibaba for $7 with cheaper shipping, I would see why people could choose Alibaba in the long run over there. Their international commerce wholesale was up 37%. Their logistics services were up 50%, and their consumer services were up 23%, and other aspects were up 42%. So their total revenue was up 34% year over year, But if they exclude Sun Art, which was one of the acquisitions they made last year, the total revenue was up 22%, which is still a solid amount, especially with the growth that they're looking at in the future. And with the stock price being down 50%, any like 10, 15, 20% growth is still very solid for a stock that has been hammered. If you look at their key investment in key strategic areas, so another thing that Alibaba does is, on top of its commerce and cloud computing services, they do invest in a lot of smaller companies. They had the IPO for their Ant Group called off at the end of last year, which initially triggered this collapse in their stock price. But they do invest in a lot of smaller companies, which provide a pretty good solid base for growth into the future. If you look at their business in progress, their gross merchandise value was up 200%, and their gross floor area was up 260% in their Taobao grocery and their Fresh Hippo market as well. Idlefish is one of their other subsidiaries, which has more than 100 million monthly active users. Taobao deals have more than 190 million annual active customers. Their LME had 50% increase in orders year over year, and their Lazada had 90% orders year over year increase as well. So their side investments are pretty profitable, and not profitable, but their side investments have a pretty good return on investment, and we're seeing what good investment choices they make here as well. So if we just scroll down here, we can see commerce specifically. They had an increase of 35% year over year compared to 2020, which is a solid increase. Their cloud computing services had an increase of 29% in their revenue, but their adjusted earnings before interest, tax, etc. was actually one of the first times it came into positive, from negative 1,000 million to a positive 340 million. Their digital media and entertainment had a 15% year-over-year growth, from about 7,000 million to 8,000 million. Their adjusted earnings before interest, tax in millions as well. Although it isn't in the positives yet, it has significantly reduced by about 100 million, close to 900 million over the last year or so. So that's a pretty good state of where this company is heading at into the future. So the next thing we'll be looking at is just an article by Jonathan Weber on Seeking Alpha, which talks about Alibaba as a coiled string. So looking at Alibaba's performance over the last year, we see a vast discrepancy between how its shares have performed and how the company's business has performed on an operational basis. So that if you look at Alibaba's stock price is down close to 40%, while their revenue's up close to 40%. So that's complete opposite. Their earnings per share diluted, which is the blue arrow, is up close to 17.5%. Their Alibaba's earnings before interest, tax is up 17.5% as well, and their gross profit is up 30%. So if you look at the business, it is growing at a very healthy rate. We're seeing revenue up 40% year over year, while the stock is down 40%. That shows why it is such a good time to invest in this company, and why I believe it is a very good time to invest in this company, and we'll be doing some technical analysis on this later. So in the above chart, we see that Alibaba's shares have declined 41% over the last 12 months. While that decline compared to the 52-week high it hit in October, it is even more pronounced, close to 50% now. The company did not experience a 40% revenue decline or a 40% profit decline. Instead, these actually grew by close to between 20 and 40% over the last year. So there is a clear disconnect between how the company is doing when it comes to growing its different businesses and how the market values its shares. To some degree, it can be explained by the fact that the shares were somewhat expensive a year ago. It was trading at an earnings multiple of 32 in August of 2020. And the longer 3-year medium earnings multiple is in the high 20s. So the stock was trading quite expensive. So the drop is more pronounced than it probably should be. But it does show that the market completely values the company incorrectly as of how it has actually been performing over the last year. Alibaba's shares have dropped more than 10 to 15%, however, and now they're at a massive discount compared to how those shares were valued in the past. In fact, a 17 times forward earnings multiple shares of Alibaba are trading at the lowest level ever, which is a very good time to invest in the company, and it's explainable by multiple normalizations toward a longer term average as well. So the first steep off was in late 2020 when the IPO of Ant Group was cancelled because of the fallout between the company and Chinese regulators. This hurt Ant Group's value, and with Alibaba, as if I'm correct, owned 33% of Ant Group, which would have hurt Alibaba's equity value as well. But it destroyed several $100 billion in market cap, and the selling was quite overdone back then. Since July, the stock has been trading quite sideways. And then the next leg down emerged with a massive sell-off in Chinese equities. Once again, the company was sold off due to more regulatory concerns, and the share price dropped from about 220 to 170, destroyed another $140 billion in equity value for the company, without there actually being significant hurt to the actual company's revenue or growth in the future. From what I know, I think they were hit by a few $billion fines, but that's a fine they make in a month's worth of revenue. So it's not too big of a deal, and it won't actually hurt Baba in the long run. So the risks that they have should not be ignored, but they're not as overwhelming as it was made out to seem. So as I mentioned previously, they had a $2.75 billion fine, but that's their net profit every month. So I was mistaken there. It's not their revenue; it's their net profit every month. So 1 month's worth of net income isn't really an issue for long-term investors, and there's nothing you have to worry about too much in the long run. The biggest point is that it's also not in China's interest to hurt its high-growth tech companies. It's one of the things that is actually driving China's economic growth. It's keeping high talent and well-paying jobs within the country. And it is also important for driving innovation and technical expertise for China to emerge itself on the global scale. So although the government might be showing how powerful it is and trying to pressure Alibaba into conforming into certain ways and not act like a monopoly, there isn't actually much harm that the company is doing to its core business. And that's why I believe in the long term, I will see Alibaba grow quite exponentially over the next few years. Another thing is that Alibaba has a massive upside once market calmed down. So Alibaba is forecasted to earn $11.80 next year, and if it was trading at the same rate it is right now, which once again, if we look at past trends, it was not trading at such a cheap price. It was trading at close to a high 20s, 27 to 30 PE ratio. But even if it's trading at a PE ratio of 20, we have a share price of $236, which is a 40% return in 1.5 years. If it's trading at 22 times earnings, it would have an upside potential of $260. And if it was trading at 27 or 30 times PE ratio, we're looking at a stock price of $354. And that is close to, if I am not mistaken, that is more than 100% return on investment in a year and a half, which is an amazing investment if you ask me. In the short term, it's returning at least 40 to 50%, up to 100% return on investment. And in the long term, we'd see this stock not definitely, but as a high chance to act like Amazon has been doing over the last 10 to 15 years. So the next thing I just want to look at is Alibaba's fair value. So based on simply Wall Street analysts, we can see the valuation of this company is 37% undervalued at $167 as of right now, compared to a fair value estimate of close to $265. So it's trading at its fair value close to 37%. There's a PE ratio that is better than the industry average, which is once again a good sign. Its price to book ratio is also cheaper than the online retail industry in the US, once again a very good sign. And their future growth looks quite promising here as well. Another thing I want to point out that Alibaba has a very, very solid balance sheet. So despite the fines that the government has been handing on Alibaba and how they have been kind of backing Alibaba into a corner, they have still managed to keep a very good base for the company. So if you look at the earnings per share, just make note this is in Chinese yen. So it's not actually in USD, but their earnings per share has almost 20 to 30 times over the last 10 years, and has been solidly growing over the last 5 years as well. So that's very good. Their book value per share has also been increasing about 4 to 5 times over the last 5 years, which is once again a very good sign. Their operating cash flow is increasing, their cap spending is increasing, their free cash flow is increasing. Once again, very good signs for the company. Their net margin of close to 20% is not the best, but it's a very solid net margin, especially for a company that is investing heavily into research and development. The return on equity of 16% is quite low for my liking, but I would generally keep a minimum return on equity of 15%, so above that, so I am pretty happy with that as well. The interest coverage means that they can pay off their debt for the next 35 years, the interest of their debt for the next 35 years. And they're extremely conservative with their debt to equity of 0.14 this, so they can easily handle any setback that the government throws at them in the medium to long term and in the near term as well. So overall, I think the balance sheet of Alibaba is very, very promising. The last thing I want to point out is the last thing we're going to look at today is the technical analysis of Alibaba. If you look at here, the stock is trading at a price that was last seen about 2 years ago. You're looking at August 2019, maybe July 2019, May 2019. So we're looking at almost at a 2-year low right now. And on top of this, it's trading well below its 200-day simple moving average, well below its 50 and 20-day simple moving average as well. So if this was a standard company, I would be slightly more concerned because of the downtrend that it is in. But because of this company and the strength, you can see they have 1.18 billion annual active customers. They're looking at 20% compound interest growth over the next few years based on what analysts expect. So I believe this is a very, very good time for Alibaba. And as mentioned previously, for usual companies, I would be concerned of the downtrend and how cheap it's trading. But because I understand the regulatory concerns that are obviously going to be there, I still believe the Chinese government wouldn't technically hurt Alibaba as much as investors are making it feel. And once the institutional investors start seeing a better light to this company over the next few months, I wouldn't be surprised if this company goes up maybe 20-30%. So once again, I do recommend buying this company. But if you do choose to invest, make sure to do your own due diligence. I do believe this is a good time to enter the market. And overall, if you do choose to invest, make sure to do your own due diligence. Thanks for watching. If you did make it all the way till the end of this almost 18-minute video, do subscribe, do hit that like button, and comment what you think about Alibaba. If not, I'll see you in the next video. Thanks for watching. Bye.